Great. So welcome to the Tear Sheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tear Sheet Editor-in-Chief, Zach Miller. The credit system in the U.S. was built on a fundamental assumption that past borrowing behavior predicts future risk, and that assumption has left roughly 100 million Americans essentially invisible to lenders. No score, thin file, or a history that doesn't reflect who they actually are financially today. And at the same time, companies like Block have been quietly extending hundreds of billions of dollars in credit to exactly those customers using real-time data and alternative models to underwrite people the traditional system can't see. My guest today is Juan Hernandez, head of credit and underwriting at Block, where he leads the teams behind Cash App Borrow, Square Loans, and Afterpay. Block recently crossed the $200 billion threshold in credit extended to customers globally, and Juan is here to talk about how they built a credit operation at that scale while expanding access rather than restricting it. Juan, welcome to the Tear Sheet Podcast.
Thanks for having me, Zach. Yeah, I'm happy to dive in on any of that. It's been an awesome journey. I've been at Block for about 10 and a half years working on all of our lending products, as you just said.
I think that's a great perspective. So yeah, let's just jump right in. Like, what does that $200 billion mark mean? What does that say about the customers you're serving? Like, that's a great place to jump in.
Sure. I think, when I first joined Block, we only had one lending product, and it was just getting off the ground, and that was Square Loans. And the problem we were trying to solve at that time was for our merchants, for our sellers, we tend to serve a lot of like micro sellers, small SMBs, and things like that. And it's very difficult to get capital as a small seller. It's very difficult to get capital in the U.S. generally if you don't have a full fingerprint or a full credit file. And we find that to be the issue across the board with a lot of the customers that we serve. It's an issue across the board with credit. And so on Square Loans, the idea that we had was, can we underwrite customers based on their sales volume? This is essentially, taking a look at balance sheets for these sellers in a way that a traditional bank might do, but in a way where the data is, just kind of native to our platform and much more frictionless for our customers. So typically what we would see with our customers is, if they don't have like a fingerprint in a traditional credit, like in a business bureau file, they just couldn't get a loan. B, they might fall back on like a consumer report at a traditional lender. And even then, like, we didn't see that they were getting access that they needed. And then C, they might have to go through tons and tons of paperwork. And so for our customers, we've kind of tried to solve this thing where we think that we're underwriting them in a way that's like unique and better than what they usually get. But B, it's also it's more accurate. And then the third part is it's also just much more frictionless. It's so easy. And so it's this thing where people might not even realize that there's credit available to them. They're just kind of used to operating this locked out system. And so we've seen that by expanding that access, we just are able to open up a whole new channel of capital and like liquidity for these customers, and changes the way that they operate their businesses. So that was Square Loans. That was very early days. And then obviously we started building it out on Cash App in 2019. And then we acquired Afterpay in 2022. The principles around all of these is very similar. On Cash App, it's a similar story where, the U.S. consumer like doesn't really have access to credit in a way that makes sense to them. What we see is that there's an enormous underserved population. And we know that there's like a lot of, bias in terms of who is served and who is not served. I'll give you like a perfect example of the type of thing that we're trying to solve. If you are new to credit, whether it's because you just turned 18 or you moved to this country or whatever other reason, there's not really an easy way to get access. And it's very similar in terms of the biases that exist to what we were describing on the business side, where in order to get access, you have to build up a credit file over a long period of time. And essentially it means that you have to take debt in order to unlock debt in this way that's kind of counterintuitive. And it's counterintuitive from the perspective of, risk management, predictive modeling, and machine learning, and like, what's the data that we're using? Like, obviously by building all of these products, we're understanding all of the patterns and all the things that go into like predicting, default risk and liquidity risk and all of these kinds of events. And so we have the insights into what data is the most predictive. I think what we found across the board with all of these products is that the traditional reliance on data sets that are like very skewed, very spotty and very sparse and missing like whole swaths of populations, that dependence itself is just kind of, that's the area that creates the need to serve our customers better.
So can you walk me through you mentioned this evolution at Block of launching different products. Can we talk about the full product suite right now? What do you guys have and what are you running?
Sure. On the Square side, we have a credit card and we have Square Loans, and we're building out different variations of the Square Loans product. We have a lot of demand from customers for shorter duration loans. Traditional Square loan doesn't have a fixed term length, but it's usually, it's usually paid back in like under a year, but over a fixed period, or not a fixed period, but over a flexible period of months.
Mm-hmm.
On Afterpay, the products that we offer in the US are Pay in 4, which is 6-week duration. First payment is done with the actual transaction, and then 3 more payments done spaced 2 weeks apart. We also have a Pay Monthly product, which is available at 3 months, 6 months, and 24-month duration. And then on the Cash App side, we have Borrow, which has a 4-week duration, and we're experimenting with other durations as well as a product that we call Afterpay post-purchase, which is that if a customer makes a purchase, they're able to finance it after the fact. And so there's all these different modalities, and this is part of what we've built as part of the Afterpay acquisition of integrating the Afterpay brand into Cash App. And then we've just released a new Afterpay Flex debit card that's being piloted in the US, which is basically a customer is able to use it either as debit or as credit. So again, it's kind of giving the optionality to the customer without the burden of having to switch between two different cards. I think across the board on our consumer side, one of the things that we see, and this is like, part of like the Afterpay DNA and the Block DNA kind of came together really nicely here, which is the way that we think about like repayments and like the cost of capital, and just kind of having these controls around is very different from a traditional revolving credit card. I think what we've seen is, like Gen Z and younger populations are kind of moving away from traditional cards. They're kind of, they don't feel a lot of trust in how a credit card works, in the sense that a credit card, you have a minimum payment, but you can revolve essentially indefinitely as long as you're making those minimum payments and the minimum payments accrue interest month over month. And so there's just there's like much lower trust in that form of lending right now. And we've seen that Afterpay is drawing a lot of customers that want to be more responsible with their borrowing. They want to have their balances settled at the end of the period and pay it off and have that peace of mind. And that's where we're really indexing on the consumer side.
I always thought Block is such an interesting company as a whole because you have both sides of the house that you guys are servicing. Is there a different DNA or a different tenor of the different teams that handle merchant side versus customers? Like, or does it feel like there's a certain shared ethos across the company?
There's definitely a shared ethos. I mean, it's different teams, but the way that Block operates is that we actually have a model that's functionalized, and meaning that each discipline reports through their discipline.
Mm-hmm.
And so like engineering has its own organization, which is separate from the product organization, et cetera. And those functional models are not like brand specific. And so what creates like the abstraction layer is this DRI model that we have. And that's where like lending is drawn through that DRI model where I'm the lending DRI at Block. And then similarly, we have DRI models that are maybe more related to like trust and fraud and things like that. And so the DNA is all shared. And so like the brand abstractions, the company, as many people know, has gone through like a change in the organizational model, where we were previously had like true business units with like GMs at the top
Mm-hmm.
of the business units. And the last couple of years, we've been making a lot of progress and just kind of changing how that operates. And so the DNA of Block is very much pervasive across the brands. And it's really one DNA that we're trying to drive through everything.
And that $200 billion milestone, is that across multiple products, or is that just the Block loans, Square loans?
That's a great question. That's loans across all of these products. Sorry. Afterpay is not technically a loan, but it includes
Okay.
Afterpay. So these are all the credit-esque products. So it's Afterpay, Square Loans, Cash App Borrow, and then Afterpay on Cash stuff that we've been building as well.
And so there's shared models across all the things, but I get how do you think about underwriting those different products across consumer, small business, and BNPL? Like, are there different risk philosophies at play?
Yeah, it's a great question. I think the risk philosophy is actually very similar across all of these. Let me start kind of like at the broad spot. The way that we think about risk is you're trying to maximize access of credit to our customers, whether it's a merchant or if it's like a Afterpay customer or a Cash App user. There's different products, obviously. Afterpay is a different type of construct than Borrow. Borrow is just capital that a
Mm-hmm.
customer can take at a point in time. And so it has like the highest liquidity and the highest utility. And so like the product philosophy is slightly different in the sense that you're serving a need for credit in a different way. And customers will attach in different ways. And so this is where you get kind of like a natural segmentation, even across like the consumer products. But the philosophy on how we manage the risk is identical across all of them, because like what we're trying to do is we're trying to manage access to capital and then manage the risk and manage the repayments. And so there's a lot of things that we've learned from these different products that really help with the risk management. I'll give you like a couple of examples. One of them is Square Loans. The way that we collect repayments for Square Loans is, and it's really like we created this like A, because it's really good in terms of our repayment rates, and B, it's very low cognitive burden for customers. On Square Loans, the repayments come primarily, and like vastly the majority of the payments come through this channel as a percentage of like processing volume. And so what this means is like if you're a Square seller, we're doing, this is the machine learning AI predictive modeling part of it, is we're doing our diligence to determine how much capital we can give responsibly to somebody. We're trying to give as much as makes sense, right? We're not trying to like limit to be overly conservative and try to have like 0% repayment rates. We're trying to manage that
Mm-hmm.
philosophically to try to get access to capital. But then the repayments are kind of coming from the sales processing. We did the same thing on Borrow. On Borrow, there's only one payment due on Borrow, which is the payment due at the end of the term. But we have flexible payment options where customers can split, rather than having like one large payment at the end of the term, they can split it into weekly payments. And there's also a feature called Pay As You Go, which is the same philosophy, which is as money comes in to the customer's account, they can select for that money to be just used to repay the loans. And so again, it's like reducing the cognitive burden and enabling that for the customers to pay off on time without having to really worry about it too much. So that's like one example where the philosophy is carrying through. We think that easy repayment, like the simple, experience and like the transparent pricing is like really core to all of these products. Another area where like the risk philosophy is very similar is underwriting. It's just like a key part of it. I think it's the predictive modeling, the AI, all that stuff that I mentioned has been like the core part of how any of these products operate. And again, it's meeting that need where like the traditional way of underwriting customers in the US and I think like globally to like a large extent is basically dependent on a lot of institutions that really haven't kept up with the pace of the technology that exists. And so when we think about the underwriting, it's been a very similar idea across all of these, which is what is the data advantage that we have? How do we think about the ecosystem that exists? Whether it's like, if it's Square, we have a whole suite of products for, processing payments and running a business. If it's Cash App, we have a whole suite of financial products for customers, whether it's investing, saving, cryptocurrency, peer-to-peer, checking accounts, and a debit card. There's an ecosystem built in there, and this ecosystem itself draws engagement, and that's the data that's like our first party, advantage. I think that's like very unique. I think there's been a lot of modernization from other like fintech lenders where it's like, okay, we're going to pull, your open banking data and we're going to have cash flow data. But I think what's really unique here is it's all first party, and that comes with
Mm-hmm.
like really unique advantages. Like one of them is that because it's first party, we're not paying for external data. We don't have external dependencies that might break and all of that kind of stuff, and like deal with like permissioning issues to access the data. That's like that's like a critical thing there. And then the other part is that because it's first party, this is such a huge engagement driver, where it's not purely that we have this data, but it's also we're able to interact with our customers in this like inside of this like broader ecosystem. And so that's been just a huge thing. And so that philosophy carries through everywhere. The data is, like very critical to us. On the Afterpay side in the US, like obviously the Afterpay data is critical to us, but then also the Cash App data that we have for customers who use Afterpay also helps those customers get higher limits and like draw the connection between like their Cash App engagement and like the limits that they're getting on Afterpay.
And that's flywheel effect, keeping people more reason to stay in the ecosystem.
Yeah.
I see we're getting near the end of our time. We have time for one last question. I'm curious about the trade-off. What might be the hardest trade-off between building an inclusive credit product while serving more? Are there cases where serving more people conflicts with other things you guys care about?
That's interesting. I think the way that I've always thought about this is our products succeed like on the lending side. This is true across all of Block, but on the lending side, I've always thought of this as we have like such aligned incentives. As I mentioned, like we're trying to maximize access. And so I think part of the reason why credit feels so lopsided in the US is because the data that people traditionally use for underwriting is just not that predictive. There's this huge aversion to lending to certain populations, where if you start entering this population with
just outside the box,
data, yeah, it's outside the box. It's all super risky. It's high loss, and so all that you can do to manage the loss is pricing, right? And that's where you get this crazy pricing. And then with all of our lending products, because we're so reliant on our unique data and we have AI models that like predict at a very, very high level of performance, we don't have that. We're pricing to the customer in a way that others can't. And I've always seen this as like, we're very aligned and we're trying to maximize access, again, to the same point, which is if we ever find, for example, like, hey, we got this amazing windfall where something happened that our margins can expand because of some, I don't know, whether it's regulatory or whatever change or some cost optimization that we find internally, we don't actually just take that back like on the margin and be like, okay, our margins just like grew. We actually think for the business and for the customer, we think, how do we keep expanding access to get it to our customers, obviously in a safe and responsible way, but trying to think about also how do we keep growing the business long term. So that's where we're always investing in growth as part of the risk management. And again, that aligns us very closely with our customers.
Well, it's been great talking to you today. Thanks for joining us on the Tearsheet podcast.
Thank you, Zach. It's been great talking to you as well.